Hi there, welcome back to FVAS. In today's video, we'll explain the upcoming April 2027 pension inheritance tax changes and what they mean for UK families.
Imagine you are a diligent company director who has spent decades building a £500,000 pension pot. You assume that when you pass away, that money will transfer to your children entirely tax-free. But what if nearly 2/3 of that wealth was completely gone before they ever even saw a penny? At Fairview Accounting Services, we help businesses and directors navigate the reality of complex tax compliance and HMRC regulations. Right now, the most critical question we are answering for our clients is this: will your pension be subject to inheritance tax from April 2027? In the 2024 autumn budget, Chancellor Rachel Reeves announced a major policy shift. Most unused pension funds will be dragged directly into the taxable estate. Historically, because most UK pension schemes operate under a discretionary trust, the funds sat safely outside your estate for tax purposes. But from April 6, 2027, that separation ends. This legislative shift turns decades of standard, reliable UK estate planning upside down. Bringing these assets into the inheritance tax net forces a complete recalculation of how wealth is passed to the next generation. If your estate exceeds the nil-rate bands, unused pensions pulled inside this new perimeter face a 40% inheritance tax. This expanding net captures SIPPs, workplace, and qualifying non-UK schemes. Crucially, transfers to a surviving spouse or civil partner remain completely protected from this tax. Bequests made directly to registered charities also retain their full tax-exempt status under the new rules. But what about your employer-provided life cover? This brings us to a specific provision often missed by taxpayers until tax returns are filed. The government has confirmed that death-in-service benefits payable from a registered pension scheme will remain entirely out of scope. They are not added to your taxable estate. So, while a safety net exists if you are leaving assets to a spouse or a charity, directing your pension to adult children or other heirs will soon become a fully exposed, highly taxable liability. The direct 40% tax is only part of the equation. To see the wider impact, we need to look at the resident's nil-rate band. This is an allowance of up to £175,000 available when you leave your main home to direct descendants. However, this allowance is subject to a strict £2 million taper threshold. If your total estate is considered too large, you begin to lose this tax-free band. The math works like this. For every £2 your total estate exceeds the £2 million mark, £1 of the allowance is permanently lost. Let's apply this to a realistic scenario. Consider a property owner with a £1.8 million estate, made up of a £1 million house and £800,000 in investments, plus a separate £500,000 pension. Under the pre-2027 rules, HMRC ignores that pension. The estate sits safely under the £2 million limit, and the family retains the full £175,000 property allowance. But watch what happens from April 2027. That £500,000 pension pot is legally forced into the total estate valuation. The total estate is artificially pushed to £2.3 million. Because it is now £300,000 over the threshold, the math dictates a £150,000 reduction in the property allowance, meaning the resident's nil-rate band is wiped out almost entirely. Losing that allowance adds £60,000 to the overall inheritance tax bill, and that is before calculating the 40. Take close attention here, because this specific age threshold is where the tax codes overlap and catch many families off guard. This chart shows the taxation of a £100,000 inherited pension pot. The first layer is the 40% inheritance tax applied to the pot alongside the rest of the estate, immediately removing £40,000. Because the deceased was over 75, a second layer of taxation applies. The beneficiaries must pay income tax at their own marginal rate when they withdraw those remaining funds. If the beneficiary is a high-rate taxpayer at 40, while HMRC does have mechanisms to prevent literal double taxation on the exact same pounds, the stacking of these two distinct tax codes results in massive wealth destruction. This double tax trap forces higher earners to rethink their decumulation strategies. Deciding which assets to spend first in retirement is now vital to protect your children's inheritance. Beyond the tax liability, the 2027 changes create a severe logistical burden for the personal representatives, the executors handling the estate after you are gone. The government originally considered making pension administrators liable for this tax. Instead, the final rules place the legal responsibility for reporting and paying the inheritance tax on the pension squarely on the executors. Executors must now identify and contact every single pension scheme you held to obtain accurate valuations exactly as of the date of death. This creates a severe cash flow problem. Inheritance tax must be settled before probate is granted, but accessing liquid pension funds to pay that bill can be incredibly slow. To address this liquidity crisis, the government proposed a mechanism called the withholding notice. Executors can legally direct pension scheme administrators to hold back up to 50% of the taxable benefits to pay HMRC directly, easing the estate's cash flow bottleneck. Even with this mechanism, leaving behind a disorganized estate with undocumented pensions will trap grieving families in an exhausting web of tax liabilities and administrative gridlock. Here is a professional tip from our tax team. Keeping meticulous, up-to-date records of your pension nominations and total estate values is now critical to avoiding a compliance disaster for your heirs. Let's review the key facts. First, unused pension funds will now count toward your total estate value and face a 40% inheritance tax. Second, the mere inclusion of these pensions can trigger the loss of the residence nil-rate band for property owners. And third, passing away over the age of 75 carries severe, wealth-destroying double taxation risks for your beneficiaries. Pensions remain excellent vehicles for funding your own retirement, but they are absolutely no longer the ultimate tax shelter to pass on generational wealth. Because these rules take effect in April 2027, proactive estate planning is no longer optional. It is a financial imperative. This video provides general guidance on UK tax rules. Individual circumstances differ, and you must obtain professional advice tailored to your specific situation. If you need to assess your specific tax liability and create a mitigation plan, contact the expert tax advisors at Fairview Accounting Services. You can reach us by phone at 0330-1333-537 or by email at inquiries@fvaccounts.com. Subscribe to the FVAS YouTube channel to stay ahead of changing HMRC regulations and ensure your family's financial legacy remains secure.